Yeah.
Good evening, everyone. One of our illustrious past president, TMA Rakesh Singh, has left on 29th March 2022. And also yesterday, Shri Sushil Behel, our government nominee, has left for heavenly abode. So requesting everyone to please join for a 1-minute condolence to pay homage to the departed souls. Thank you, everyone. So, good afternoon, everyone. Welcome to the webinar today on the topic on fiat currency versus cryptocurrency versus central bank digital currency, organized by Banking Financial Services and Insurance Board of the Institute of Cost Accountants of India from 4 to 6 p.m. As cryptocurrencies such as Bitcoin has become an increasingly established part of the financial landscape, central bankers have begun to explore the broader potential of digital currency more seriously. These days, central bankers worldwide are fired up about the idea of digital currency. Specifically, they are increasingly intrigued by the idea of central bank digital currencies, which are essentially digital versions of traditional fiat currencies. Today, we are privileged to have with us Shri Vikas Babu, DGM Treasury Union Bank of India as the faculty for the webinar. We are also having with us CMA Chittaranjan Chattopadhyay, Chairman BFSI Board, Shri Shamul Ghosh Roy, Consultant of the BFSI Board, CMA Dibbendu Roy, Additional Director and Deputy Secretary of BFSI Board of the Institute. Before we start, we are gracing this program with the Institute Anthem.
Is there a technical glitch? Then we shall finish it with our anthem. Induction, if there is a technical glitch, we shall finish it by anthem.
Sir, it's not visible.
Okay, no, it's not visible. I think some glitches are there. You just carry on. Let us finish with institute anthem.
Okay. I would now request CMA Chittaranjan Chattopadhyay, sir, Chairman Banking Financial Services and Insurance Board of the Institute of Cost Accountants of India for the opening remarks. CMA Chittaranjan Chattopadhyay sir is a science and law graduate from University of Calcutta. He is a fellow member of the Institute of Cost Accountants of India, a certificated associate member of the Indian Institute of Banking and Finance, an associate member of Chartered Institute of Public and Finance and Accountancy, London. He is a practicing cost and management accountant. He has 38 years of experience in the banking industry. He is one of the resource persons for bringing out several publications for the Institute on Banking. At present, he is Central Council member and chairman of Banking, Financial Services and Insurance Board of the Institute, Indirect Taxation Committee, and also chairman Task Force on MSME and Startups of the Institute of Cost Accountants of India. He is also board member of ICMAI RVO, AAT Board of ICAI, and director of ICMAI Management Accounting Research Foundation. We welcome you, sir. So over to you for the opening remarks.
Thank you, Induction. Very respected, my president of the Institute of Cost Accountants of India, CMA P. Raju Iyer, my vice president, CMA Vijendra Sharma, who could not attend since one condolence meeting is going on in between to for on the departed soul of our Shri Sushil Bhel. But they have expressed their happiness for this particular program on the cryptocurrencies. Very respected speaker and chief guest of this occasion, Shri Vikas Babu, the Union Bank of India, and a very vastly knowledgeable person on treasury, and our consultant of the BFSI board, another very knowledgeable personality of the banking sector, Shri Shamal Ghoshra, our additional director, CMA Dibyendu Roy, who is always been instrumental for organizing these sort of programs with all motivations, and Indrakshi and all my BFSIB members, staff members, and particularly all my council members, those who are always inspiring me for these sort of programs. Friends, all the attendees who are here, I convey my gratefulness to them that they have been kindly enough to learn, unlearn and relearn about this cryptocurrencies and various currency model, what is going on in the Indian financial system. As you know, that before I just put some of my views on cryptocurrencies, I want to introduce our BFSI board to our very august speaker, Shri Vikas Babu, because our institutes, this BFSI board is now catering to the needs of the banking fraternity as also for the society as a whole. And this banking, financial service and insurance board is continuously thriving in our objective of knowledge dissemination. We have just released the 9th issue of the BFSI Chronicle, which is the first of its kind by any professional institute, that we are continuously we are publishing this BFSI Chronicle, not only for the bankers, but also for the those who try to understand what is happening in the BFSI sector. And soon we will see the light of the day of an unique publication titled Aid Memory on Infrastructure Financing. And this is one of the projects we have undertaken from BFSIB. And you'll find that this is also another unique production from the institute for the cause of the bankers, for the cause of the infrastructure, entrepreneurs or corporates. This would be serving in a huge way, is having a 360-degree view on the infrastructure financing, and it will be a useful handbook for the financial institutions, including banks who are financing huge infrastructure projects, and also to the professionals who can now refer to such a manual which depicts the whole gamut of the intricacies of the infrastructure financing. The BFSI board are regularly conducting webinars, Webints, and other discussions forums for sharing knowledge in various relevant areas of the financial world. Now we are planning to start a BFSI quiz contest for invoking the interest of financial knowledge among the shareholders and among the stakeholders. We would also organize an essay competition for the bankers, which should be our second year in this foray. And I request our chief guest, who is in the bank, Union Bank, kindly take a view on this, how the bankers should be more and more, they should be involved in this process of our quiz and essay competition. We'd also organize a physical BFSI conclave, which will be a national BFSI conclave at Mumbai in the banking month, that is July 2022, and many other activities which will engross our members and students to understand, comprehend, and assess various pertinent issues of BFSI. Friends, today's webinar is on, is a very interesting topic our department has chosen. Fiat currency versus cryptocurrency versus central bank digital currency. If we go to the history, what we see in 2013, Bitcoin begins to trade on multiple exchanges. RBI cautioned citizens for Bitcoins, citizens of these Bitcoins. 2014-15 we have seen crypto exchanges formed in India. Awareness increased. Then 2017, no regulation in India. RBI stated that virtual currency is driven by speculators. 2018, circular issued by RBI to banks to stop providing any services to any individual or business dealing with or settling digital currency. So 2018 scenario was such that 2019, the banning of cryptocurrency and regulations of official digital currency bill 2019 bill were tabled. And when this bill was tabled in 2019, that time 2020, Supreme Court set aside RBI circular and held the same as manifestly arbitrary based on non-reasonable classification, and it imposes disproportionate restrictions and allows cryptocurrency trade to be supported by the financial system. The Supreme Court stated also that cryptocurrencies are unregulated but not illegal. So 2020 it took a turn. Then 2021, the cryptocurrency regulation of official digital currency bill 2021 tabled for discussions. And as you know, in 2022, announcement in budget 2022 approved in Lok Sabha, income tax on transfer of virtual digital asset at the rate of 30%, set off losses, same source or other source not allowed, 1% TDS on all crypto transactions, only cost of acquisitions will be allowed as deductions, and expenditure on mining of infrastructure not to be treated as allowable. And if we see that the cryptocurrencies, for this particular recognition came amidst the characteristics of cryptocurrencies, what we have observed and we have listened, we have learned so far. And I think today's program will be definitely very enriching for us to know further, because many informations, many various articles we are reading from the various financials dailies, and various books are also there in the market. What we have found that there is a decentralized authority free from control by one person. Regarding cryptocurrencies, these are the characteristics we found. This cannot be forged. Very lower transactions fee. Uses blockchain as base. Approximately 4,000 cryptocurrencies around the world has been issued. Transaction verification is time consuming, and float of cryptocurrencies came. If the miners protest, then entire system can be exploited. No grievance mechanism in case of incorrect transactions. So you see that there are a lot of issues are there, lot of insecurities, improbable some thought process is coming. how these cryptocurrencies will be ultimately, whether it will stabilize, whether it will not destabilize, it will be having any other effect on the Indian financial system. You know, some of the popular cryptocurrencies already are established. I have told the Bitcoin, then Litecoin, Ripple, Dash, etc. And these are not backed by any government. And they don't need any intermediary to buy or sell them. How the market will grow, how the market will be there, how the protection of the users of cryptocurrencies will be there. In fact, the growth of cryptocurrencies cannot be simply, it's a great. It has been hopefully increasing into November 2021. Total number of 15 to 20 million Indians have invested around $6 billion, which amounts to rupees 45,600 crore rupees in cryptos on digital platform. There are nearly 40 such crypto exchanges and lure potential investors. One thing is clear, RBI government has also imposed taxes, and RBI also the regulator, they want to protect the interest of the investors, the common people. Common people should not be falling under any sort of, indefinite, system. There should be a definite system, because that Indian banking system is a robust banking system. The risk mitigation process is robust, and because of that, we remember in Lehman Brothers case how Indian banks survived, because the risk mitigation process is very robust. And even after the adoption of Basel Capital Accord, Indian banking system, maybe there are some problems that cropped up because of this adoption, because many sort of debatable issues have come, but still Indian banking have showed their resilience to any sort of risks. And in this scenario, historical decision has been taken that RBI would be launching the digital currency soon in financial 2023. And how it would be done. So here, what can be the best personality than Mr. Vikas Babu, who will be today delving on this issue. I welcome you, sir. With this, I am very much thankful to Shamal Ghosh, who has become the instrumental for holding this program today. And we'll be definitely looking forward for your further participations in our program. And you'll be very happy to know that the way we have started this BFSI board activity, it is not only for a CMA professional, because we have got today the 111 chapters representatives up there. We have got 800 ROCCs. We have got 4 regional councils. We have got more than 5 lakhs of students, and we have got more than 90,000 of members. And members from abroad, members from India, they all join for this particular BFSIB program. So I am very happy in presenting this particular program, which must be very much thought-provoking, that fiat currency versus cryptocurrency versus central bank digital currency. So over to Induction for further navigation of the program. Thank you.
Thank you so much, sir. So I would now request Shri Shamul Ghosh Roy, consultant of our BFSI board, for the special address, just sharing his profile. Shri Shamul Ghosh Roy is a seasoned banker with more than 35 years of experience as officer and executive. He has joined the bank as a probationary officer. He is skilled in foreign exchange management, treasury management, credit management, organization, and strategic planning. He has worked as general manager at Andhra Bank, head office, Hyderabad. He has handled corporate credit, MSME credit, and retail credit verticals of the bank. He has handled all operational areas of export and import, like management of export bills, opening of LCs, handling of import bills, and miscellaneous remittances. His areas of specialization and interest is credit management, credit monitoring, foreign exchange, treasury management, inspection, and audit and board matters. We welcome you, sir. So over to you, sir, for the special address.
Thank you. Thank you. I welcome because I just like to know whether you have any problem with the audio, because I'm having the problem with the audio. There is an echo coming. What is
from my side?
So
So I am able to hear it properly. I don't have a problem with the audio.
okay, fine. So thank you, Induction, and thanks, Mr. Chatterjee, for such an elaborate analysis of cryptocurrencies. So I have nothing to offer on that. I will come back later on. What I want to say is I have a very good, what to call working experience with this young chap, Vikas Babu. I go back to 2008 when I shared the dealing room, and he was the USD INR dealer at that time, and there was actually a lot of volatility in the market. Because made plenty of money during that time because of the Lehman crisis, and because loves to have volatility in the market as any other dealer likes. So I don't add anything more here because what Mr. Chatterjee said at the end of when he said that the finance minister has imposed 30% tax on this what you call digital transfer of income from transfer of borrowable assets at the rate of 30%. So my questions are, we all know that there is a lot of differences between Reserve Bank of India and the finance ministry. There are a lot of discussions and all. We can discuss this later on, and I think we'll be talking a lot about this also. So my questions are, does this statement effectively remove uncertainty about the legal status of such transactions in India? Number one. And does this position tax make crypto trading official now? These are my two questions. I hope you cover in your particular presentation. And once again, welcome you for this students' webinar. Thank you all.
Thank you so much, sir. So I would like to now introduce Shri Vikas Babu. He is an MBA Finance. He is BCom Honors. His diploma in Treasury Investment and Risk Management from IIBF. He is an ACI Dealing Certificate. He is a CAIIB. He has 18 years experience in treasury operations, both back office and front office. He has 2 years of experience as branch head. He had been an occasional financial trainer since 2009. He had delivered lectures in NIBM Pune, Trinity Academy, Manipal Institute, Bank of India Staff College, Andhra Bank Staff College, Sita Devi Institute of Financial Learning, etc. He is currently the Secretary of Forex Association of India. He is the Management Committee member of FEDAI. His current designation is DGM, Treasury in charge of the dealing room, Forex, money market, bond market, equities and derivatives. We heartily welcome you, sir. So over to you, sir, for your address.
Thank you. Thanks for your nice introduction. Respected Chittaranjan ji, Shyamal ji, and all the members of the CMA. Today I'll just share my presentation. Today I'm going to share the present. Yeah. Is my presentation visible?
Yes, sir.
Yeah, fine. Yeah. So the topic for the day is fiat currency versus cryptocurrency versus central bank digital currency. Where are we actually headed? That's the question for the day. Before we start, I would like to say that I'm going to cover fiat currency. We dwell upon the fiat currency, which you already know. We just dwell upon what are characteristics of the fiat currency. Then we'll slowly move to what cryptocurrency is, what is the underlying technology that is being used for cryptocurrency. And then we'll go back to, we'll finally land at central bank digital currency. And in whole the topic, Chitranji has already covered few of the points which I have to mention. So he's given the perfect start for what I wanted to start. So we all know we are part of evolution everywhere. From the Stone Age to the modern age, now we have evolved from Stone Age man to the modern man now. Similarly, our transactions also were evolving all along. If you see, initially it started with what we call the barter transaction, where one goods is bartered for other good. Possibly wood is bartered for food. So that was the thing that was actually happening in the barter transaction way back in ages. Subsequently, for the ease of transaction, they have moved to the money transaction, where we have the bartering or transaction between money and goods. You give money, take goods and give money. That's the kind of transaction we have slowly evolved to. Subsequently, with the nationalization of currencies, we have got so many nations, each currency has a different nation, but trade has become internationalization. With the nationalization of currency and internationalization of trade, we had slowly moved on to the forex transactions or the currency transactions, wherein I trade for one money for other money. That is one currency for other currency. This is what we call the forex transaction. Now we are in a situation, since 2008, we are slowly transitioning ourselves to crypto transactions, wherein I use the crypto, what we call the, we delve deep into it when we go in there. We transact one crypto for money or good or other crypto. So this is the transition or evolution we have been seeing all along the ages. Now we're in the phase where we are slowly moving in from the forex transactions to the crypto transaction. Starting out with fiat money. What exactly is fiat money? In the earliest eras of civilization, societies dominated money in livestock such as cows, goats, sheep, or camels. Slowly, they evolved to the cowrie shells from the Pacific and Indian Oceans. Salt also was sometimes used as fiat money. This is the form of money that has been used over ages. Then it gave to what we familiarly know now as the precious metal coinage, where it has been copper, brass has been used as coins or currency or money for transactions. In the current context, we are actually having what is called fiat money, which is the notes and coins which represent the money for us right now. Fiat money is physical money and legal tender, which is backed by a nation's government. So fiat money has to be backed by a government or a central bank on behalf of the government. Then only it becomes a legal tender. More specifically, fiat money is the money that lacks intrinsic value. If I pick up a 500 rupee note, the cost of the note, intrinsic value of the note is hardly 2 or 3 rupees, but the value that represents is 500 rupees. So fiat money derives its worth from its status as a legal tender, which is issued by a central bank backed by the government. As long as money operates effectively as a medium of exchange, store of value, and account unit of account, as long as we have got these three characteristics, it will be categorized as money. We'll go a little deeper into this. The three main characteristics are medium of exchange. Money is an effective medium of exchange. Consumer need to know that they can easily purchase the goods and services they need. For example, when I go to a grocery shop, I should have faith that this guy, the grocery shop owner, is going to accept the payment which I make in rupees. I should not have any doubt there. If I got a doubt that is not going to accept it, it is not a medium of exchange and I will not be able to do the transaction. So when I go to a bank, I should be having faith that the bank is going to accept the money as mortgage payment. So that's what is medium of exchange. Then we move on to store of value. Money operates as store of value. For money to function, consumer needs to know it will retain its value over a reasonably longer period. For example, if I earn 1 lakh rupees a month over a month, I should be confident, I should have faith that by the time the salary is paid to me at the end of the month, the value of the currency doesn't move from the expected 1 lakh rupees. So the assurance of the stability of value, which is the thing which gives the strength to the money. That's what is fiat money. And third characteristics is unit of account. Money is a unit of account, which means it presents a way of measuring the value of every economic transaction. For instance, money expresses the cost of a mobile phone of 90,000 rupees in relation to a hat which costs 50 rupees. Without a unit of account, there is no way to determine the intrinsic value of goods and services. To be considered as fiat currency, the medium must be durable, portable, divisible, uniform, unlimited in supply. These characteristics will determine how any unit works as a medium of exchange or store of value and unit of account. So to make the things more clear, I'm drawing a comparison between a 500 rupee note and an elephant to assist us in understanding the traits of the fiat. First one is the durability. The physical durability of the fiat is an important consideration. A 500 rupee note is quite durable as it is as an elephant, but with a varying degree. The 500 note is durable for certain amount of period, and elephant has got certain lifetime. There's a varying degree for durability there. Next is portability. How portable money is will determine its suitability as fiat currency. For example, a 500 note can easily fit into my pocket, but the elephant can never fit into your pocket. So that it can't be used as a fiat there. Divisibility. Fiat currency needs to be divisible to act as a unit of account. A 500 rupee note is divisible into smaller notes or currencies, whereas an elephant can't be divisible. So it can't be construed as a fiat currency. Uniformity. A 500 note is always the same size, same shape and same value. But an elephant can come in different sizes and shapes and value, size and shapes. And one more feature of fiat currency is fiat currency needs to have a mechanism controlling the supply of money. Central banks control the supply of 500 rupee notes. Elephants are technically limited in supply, but if elephants were considered fiat currency, there would be an incentive to breed more of them. So if I can refer one point here, the mining which we talk about in cryptocurrencies actually is an incentive. When you know there's a value for particular crypto, you try to mine it. So the incentive for breeding for elephant is akin to the mining which we do in cryptocurrencies. Fungible. One note of 100 can be exactly substitute for another note of 500 rupees. So we all know what fungibility. Fungibility is exactly replacement of one item with other currency without changing the value of the particular item. Whereas an elephant can't be replaced exact back to back because there can be change in the size, there can be change in the age, there can be change in the strength, it can be anything, height or anything. But the 500 note is exactly the same wherever you use it. So this is the other feature of fiat currency. So having known what exactly a fiat currency is, so we'll start to see why people are actually trying to move away from fiat currency. Although fiat currency continues to facilitate nearly every transaction on the planet, the concept of money continues to evolve. As we already discussed, that evolution is part and parcel of a human being, and there is evolution that keeps happening in the finance also. Since emerging in the 11th century, fiat has remained the dominant mode of transaction. Though there has been a foundational changes to the way it is produced, like it has moved from cowrie shells to copper brass coins, finally to the current currency notes and coins. Despite facilitating crucial economic activity, fiat is susceptible to fiscal and monetary crisis. This is one point that actually been holding on for the people who are having currency in hand. As monetary crisis and inflation remain major economic issues around the world, consumers' desire for money that is not controlled by central institutions has grown tremendously. Payment systems such as credit cards and wire transfers are outdated right now. We have got few latest technology that's actually making them outdated. Intermediaries like banks and brokers charges make the transfers and transactions expensive and also slower. The world was looking for more efficient, less costly infrastructure. There is also an issue related to the trust. When the 2008 financial crisis happened, the crisis has actually started out with banks and financial institutions aggressively lending into the mortgage-backed securities, which are actually weak. But if you see the structure, not even a single banker has gone to the jail. And who has suffered a lot is the public who are holding the money in their hands. They have lost the values which were attributed to them sometime in the past. They have lost depreciation seen in their own value of any financial asset which they were holding by 30–40%. And what has the government done there? The governments have used trillions of dollars to bail out the very financial institutions that have caused the crisis, who are the reason for the crisis. So that actually started the mistrust issues with the government and the kind of fiat money that we have right now. If we can have a Russian war case right now, Russia is holding about $650 million as reserves and about $220 as US in denominated in US currencies, USD. With sanctions levying on Russia, Russia is not able to use the fiat of US for its advantage. Though it is their own money, they are not able to use it. Then what is the point in having reserves in dollar at this point in time for Russia? So this is also a trust issue that's being developed across the globe, and people are wanting to have a new way of dealing in the money. The emergence of blockchain technology and cryptocurrencies are laying the groundwork for the next generation of money. On August 18, 2008, Satoshi Nakamoto, a pseudonym, registered the domain name bitcoin.org and created a website at that address. On 31st October, Mr. Nakamoto published a white paper on the cryptography mailing list at mets.com, describing a digital currency for the first time in this world. This is the first time someone used the word digital cryptocurrency, and he titled the paper Bitcoin, a peer-to-peer electronic cash system. This really is the start of journey of the cryptocurrencies. I will move into what cryptocurrencies are, and I just want to say something here. I didn't want to go deeper into what they are, what are the advantages, what disadvantages. I tried to cover the aspect to differentiate what fiat, cryptocurrency, or CBDC are for us and how we can actually, how it has evolved and how it is going to help us in future. And to make little more inputs to the listeners, I have added few slides on the technology behind it so that you can understand and correlate whenever you hear, because these are the words you keep hearing in future. And if you don't know anything, actually, we will not be able to grasp what the point is being made. So what is a cryptocurrency? Cryptocurrency is a form of virtual or digital currency that is secured by a cryptography based on a network that is distributed across a large number of computers. And many cryptocurrencies are decentralized networks. Not all are decentralized. Most of them are decentralized. And they are based on the blockchain technology. A blockchain technology is a distributed ledger technology by network of computers, which allow participants to enforce the rules of the system in an automated and trustless fashion. So there is no centralization required when it's a blockchain technology, because it is technology that is going to show that clear the transaction on peer-to-peer level. I'll go in detail about what exactly blockchain technology is. A defining feature of cryptocurrency is that they are generally not issued by any central authority. That is the most defining feature, rendering them theoretically immune to government or central authorities' interference or manipulation, and offer significant opportunities for financial inclusion worldwide. When this Mr. Satoshi Nakamoto, which we talked about, no one till now knows who that Satoshi Nakamoto is, who is supposed to be the founder of Bitcoin. It can be a group of person, it can be a single person, or we don't know. No one knows what exactly is Satoshi Nakamoto. So with it actually started out with the crisis which we had in 2008. People didn't have lost trust So they are looking for a new technology, new way of money. That's where the blockchain technology came into being, and this has actually moved into a new world called the cryptocurrency world. Now, before we discuss about the pros and cons or similarities or dissimilarities with the fiat currency, we will try to understand what blockchain technology means. Blockchain is the name of the new technology based on which your cryptocurrencies are formed. And one point to be noted here is cryptocurrencies, blockchain is not only used for cryptocurrency, it is one small part of the uses of blockchain. It can be used for many other uses. What is a blockchain? Blockchain is a sequence of blocks or group of transactions that are chained together and distributed among the users. Blockchain is an incorruptible ledger of economic transactions that can be programmed to record not just financial transaction, but everything that has got a value. There are five key concepts we need to understand for the blockchain technology to be understood. The five key concepts which you need to understand is, first one is the crypto hash. Second one is the immutable ledger. Third, P2P network, peer-to-peer network. Then the consensus mechanism and the mining. These are the five major concepts to be understood to understand what exactly blockchain means to us. We will go in a little bit about what these are for us. What is a cryptographic hash? A hash is a cryptographic function that transforms any input data into a fixed length string of numbers. Every single input of the hash function will produce a different output, and the result is deterministic. If you use the same input, the output will always be the same. So this is a kind of code that is actually being used in a cryptocurrency. The most important feature of the hash function is that the conversion is only one way. It can't be done on the reverse function. So once you have a original input done, it is very difficult to duplicate it on double spend it. So to just give a picture as how it works, if I want to say hello, this is the code that is actually formed behind in your computer systems across the globe, across the piece of network. And this code remains the same. Whenever you say hello, this is the code that is being used. You can't actually change the hash for this. Blockchain nodes use hash functions to create a unique identifier of any block of transactions. Every block includes the hash value of the previous block. So that's when you have the link of all these blocks together, it is called a blockchain. Every block gets linked with other, and hash code gets linked that way. Then we go into what immutable ledger is. Since every block of chain contains the hash of the previous one, it is not possible to modify any block without changing the entire chain. If I want to modify anything in between, I have to make the entire change in the entire chain. That is the reason why it is called immutable digital ledger. So tampering with this is very, very difficult, because if I have to tamper with something, I have to tamper from first chain to the last end of the chain. It can be any number of transactions that it can take. So as we already discussed, the hash of first chain will be linked to the hash of the second one. Every block has been hashed and the hash is included in the following one. So anonymous attacker removes, adds or modifies any transaction in the first block, the hash one will change. Hash one is included as part of the contents in block 2. Because of that, hash 2 will also change, and the error will be propagated to every block of the chain after the block under attack. The user will then declare the chain as invalid. So when an attack happens in one chain, because the original chain has been actually hashed to the second block, it rejects, saying that is not correct. So if you have to change anything in this code, I have to change the full chain altogether. So attacking this particular technology is very difficult. This is the security feature that is available in blockchain, which is actually being used across the industries. That is, the ledger is immutable. That is the reason people want to actually do it. There is no hacking. That hacking can be done, but it has to be at a severe. It will take a lot of time to hack it, and it's very, very difficult process to hack it, because you are not going to manage one server. It is a peer of computers, set of computers across the globe We have to manage everything to get into done. Then the third concept we need to understand is the peer-to-peer network. The blockchain does not need any external or internal trust authority. This is possible because the blockchain data is distributed among all the users. So any transaction happen, it gets stored in every user of the blockchain. Every user has its own copy of the transaction and hash blocks, and they spread the information of any new transaction to the entire network. This way, it is not possible for anyone to alter the information in the chain, since it is not stored by an individual entity, but for an entire network of nodes. Once a block of transaction is validated, it is added to the chain, and every user updates this local information. So once I create the new transaction and validated by everyone in the peer group, it gets added into the transaction, and this block gets recorded there, and it can't be changed once it is recorded. Even if an attacker were to modify your local change, the network will not accept any block from the altered blockchain. Then how are we going to authorize this? The authorization of this particular block is going to happen by what we call the consensus protocol. User need to meet an agreement about the validity of the chain before adding more blocks. Every time a node adds a new block, all the users have to validate the block by using a common protocol. Today, the nodes reach a consensus about the correctness of the new block by what we call proof of work or proof of stake method. There are two methods that actually popularly used. Bitcoin uses the proof of work kind of a protocol, where using the protocol, the chain gets validated. The nodes check that the new block meets the requisites of the proof method, including validation for all the transactions inside the block. If the block is valid, they consider it as a part of the blockchain, and they keep adding new blocks. Then this is what we must have heard: crypto mining. So whenever the block validation is done, it is deemed to have been mined. You are going to mine a new cryptocurrency for yourself. That is the reward you get for authorizing the transaction or validating the transaction. Mining refers to the act of meeting the proof of work requirements for adding a new block with pending transactions to the blockchain. There are many different mining methods as they are custom defined for the chain. The proof of work method usually requires the user to create a block with restrictions on its hash code. Since the hash code is unpredictable, as we said, every new input changes the hash code. So it is unpredictable how it works. The miners have to test any possibility combination before meeting the requirements. These restrictions define the difficulty of the network. So crypto mining is not so easy because it needs a lot of power, actually raw power, which we talk about. That is very required, and there are so many iterations that needs to be done to create a new cryptocurrency. Once a miner node finds the solution to the power of work problem, they add the block to the chain, and every other node checks the validity of the power of work. According to the consensus protocol, if the block is legitimate, they will include it in the local copies of the blockchain. So once that gets embedded into the blockchain, it gets mined. So you have got additional cryptocurrencies that have been generated out of this system. To sum it up, blockchain allows user to create a reliable and immutable system for recording any kind of transaction or information. There is no need for an external or internal authority because every user relies on the technology itself, following preferred rules to meet consensus and ensure the integrity and authenticity of the data is intact. Now we'll go into what are the exactly differences between crypto and fiat. If you consider the point of medium of exchange, fiat currency is commonly accepted as medium of exchange, whereas cryptocurrency, there are issues in relation to acceptance. But if you talk about in US, most of the bigger shops or businesses are accepting cryptocurrency as way of payment. If you have heard recently, Tesla has said that they will accept cryptocurrency as part of payment for their cars. But within a matter of 10 days, they have said, no, we don't want to take it. They took it back. So the crypto can't be used as a medium of exchange as long as people don't have faith in it. Store of value. Fiat currency has got store of value. Money will retain its values. Of course, subject to inflation and currency and ineffective monetary policy, like what we had in Venezuela, where the inflation is running high and the value of currency just deteriorates or the Sri Lankan issue, which you have seen 50% depreciation in hardly any time. So the store of value issue is going to be resolved, or we can see that the Vietnam is dong, which is predominantly linked to gold than the actual currency. People prefer gold as a medium of exchange than dong there. Coming to cryptocurrency, the store of value is very difficult to define because, as I told you, the example of Tesla, the volatility in the prices of the cryptocurrencies are so huge. There were days when we have seen cryptocurrencies crash by 50% in a day. You invest 1 lakh rupees, the next day you see it as a 50,000. So the volatility can't ensure the store of value in the cryptocurrency. But we have, as we say, it keeps on evolving. There are something called stable coins which are pegged to the underlying asset like dollar. So that were giving some state or stability to the cryptocurrencies, but not all cryptos are stable coins. There are very few like that. There are also risks associated with stable coin that we'll discuss subsequently. The third differentiator which I've talked about is intrinsic value. Meager intrinsic value, but derives its perceivable worth from its status as legal tender. A fiat currency doesn't have any intrinsic value, but because it's a legal tender, because it's backed by central government or the monetary policies or fiscal policies, it actually gains value there. Whereas in a cryptocurrency, there is no intrinsic value whatsoever. It is a virtual currency or digital currency, but derives its intrinsic value from its native blockchain, where monetary policies are transparent and written into the protocol's code base. While cryptocurrencies often have no fiscal policy, it is important to remember that the monetary policies are subject to the governance and consensus mechanism of the protocol. So the consensus mechanism which you discussed just now, actually can be called as the monetary policy of the particular thing. It is only a reference I am giving. Actually, it's not the case. And it is actually not done by a single authority. It is done by a peer of networks. Then you use the differentiator of intermediaries for exchange of value. For a fiat currency, except for cash transaction, we need intermediaries like banks, credit card companies, wire transfer companies, payment companies for doing the transaction. RBI can't directly deal with you. They need an intermediary to work the thing done. Whereas in a cryptocurrency, there is no intermediary required. The transaction is always peer-to-peer. They occur via blockchain without the need for any centralized intervention, instantly giving the system's users more freedom. But there are intermediaries required here also, but because the system is formulated in such a way, there is minimal requirement of intermediaries in this particular blockchain or cryptocurrency. Extreme money printing. By resorting to quantitative easing, a government may be able to bail out debt or devalue its currency. For example, when a country like Iran or Venezuela prints too much money, the value of its currency drops so much that the inflation skyrockets and people can't even afford to buy everyday goods and services with the money they are holding. Whereas in a cryptocurrency, they are limited in supply. So most cryptocurrencies are limited in supply. Set amount of coins are available. And the mining which you talked about, in certain cases, you can't mine beyond a certain amount. Bitcoins can't be mined beyond certain amount. When all those coins are in circulation, a central entity or the company behind the blockchain has no easy way to simply create more coins or add to its supply. So the supply is limited in case of a cryptocurrency. You can have hundreds of cryptocurrencies, but each and every cryptocurrency has got a limited supply. But currently we have got a new cryptocurrency by name Ethereum, which is unlimited. So as I was telling you, there is evolution that is actually happening. We need to find out where exactly we are going to land there. And the idea behind this presentation is also to get fair idea of actually what's happening around. We don't have a fixed solution going around. Coming to the regulation side, fiat currency is completely regulated, whereas cryptocurrencies regulation is completely lacking, and it gives huge risk to the investors of the cryptocurrencies. In relation to the form of holding, held physically as paper currency or coins, or held electronically as wallets, or held in bank accounts as bank balance. Whereas cryptocurrency, it exists only in the electronic form. You don't have a physical form for the cryptocurrency. Giving people charge of their own money. In a case of fiat currency, central government is charge of your money. For example, what happened in 2016 demonetization? They finally decided 2000 notes are going, 1,500 notes are going to be blocked, and that's happened. If I had to buy anything on the day, I can't do anything in the mercy of the government to get it exchanged. So the control is completely in the government's hands. As already discussed, the Russia case. Currently, they have whole dollars, but they can't use the dollars because they are not allowed to use the dollars. So the control is on the issuing authority, that is the government or central bank which is issuing it. In case of a cryptocurrency, you and only you can access your funds. Of course, this is also a pain point in cryptocurrency. Once you forget your password of the system, you can never retrieve the funds you are having. Whatever may be the cryptos you are holding, that goes redundant. You can't never accept it. You can never access them. That's the biggest risk with cryptocurrency. So only you or the person who knows your password only can actually access the thing. Otherwise, you can't access. You have got complete control over your cryptocurrency which you're holding. Going to the security. Security in a fiat currency is moderate because they are susceptible to counterfeiting. It's not so easy, but they are still susceptible. But in case of a cryptocurrency, it is a highly secure. The encryption technology that is used assures the authenticity of the crypto assets by eradicating the possibility of counterfeiting. And the concept of double spending also can't be done in a cryptocurrency. You can't double spend it. That's where the blockchain actually got the prominence. Anonymity. In case of fiat currency, intermediary exists. So transactions can be easily tracked by any central authority if they want. But in case of a cryptocurrency, transactions are verified as per consensus mechanism or the group code which you have. And it is not verified by the purpose or the counterparties of the transaction. It is only the verification as per the consensus mechanism. So anonymity can be maintained in a cryptocurrency. Before we go into the next topic, I would like to add few jargon of cryptocurrencies, because more often than not, we read an article, most of the points we think we understand, or we think that it's a big jargon, I can't understand, we leave it at it. So I'm making a smaller attempt to give 6 or 7 jargon to just understand. When we read an article, we know what we're actually talking about. First, when we talk about Bitcoin, Bitcoin is nothing but a cryptocurrency. This is the first cryptocurrency that has been done by Mr. Satoshi Nakamoto, as we have discussed. This is the first cryptocurrency. And we have seen mushrooming of cryptocurrencies coming there. Almost 46 or 47,000 cryptocurrencies are available in the market right now. And it has been increasing. 1 year back, it is only 22,000. It's just 47,000 right now. So it keeps on increasing and is mushrooming at the pace which are not known. This is the first cryptocurrency, and if you see the by market value, market capitalization, Bitcoin is constituting almost 60% of the total market capitalization of the cryptocurrencies right now. It was 80%. It's getting dwindled, and Ethereum is taking that place right now. Then you must have heard the word altcoins. Altcoins are nothing but any cryptocurrency other than Bitcoin is considered to be altcoin. Because Bitcoin is supposed to be the big daddy of cryptocurrencies right now, because that is the one actually that started and is the biggest cryptocurrency in the market. So any other currency, we usually use the word altcoin. So it is like altcoin and Bitcoin. So tend to see lower levels of acceptance among other currencies. Example, Litecoin, Dogecoin, Ethereum. There's so many other things coming in. Then one point which you need to see is the stable coin. As you have discussed, cryptocurrencies have huge volatility in the valuation, so it can't be used as store of value. But that has been done away with the evolution of stable coins. Stable coins are a class of cryptocurrencies whose value is derived from the value of an external asset, like dollar. They can be backed by any collateral, either fiat, crypto, or commodity, to ensure price stability. Example, Ether is a stable coin backed by dollar deposits and have a value equal to USD. So whatever may be the value of USD or stable coins remains to be the same. So it stable coin retains the advantage of all the cryptocurrencies and remove the disadvantage of volatility in the price. That is the store of value. Then we must have heard this word digital asset. So digital asset is a non-tangible asset that is created, traded and stored in a digital format, electronic format. The term covers a variety of assets, including cryptocurrencies, utility tokens, security tokens, digital stocks, digital collectibles, whatever you want. Anything that is digitalized is called a digital asset. Even NFTs are considered as digital assets. All cryptocurrencies are digital assets, while not all digital assets are cryptocurrencies. There are some assets which are not. There are many assets which are not cryptocurrencies. Then we must have heard this word fintech. Quite often we use the word fintech. Fintechs are nothing but a platform that represents a new era of innovation in finance. Most fintech companies build platforms that remain dependent on traditional financial infrastructure and seek to improve the delivery and accessibility of traditional financial services. Compared to traditional banks, leading fintech companies put consumers first by lowering costs, providing customized advice, easing money mobility, losing lending requirements, and offering user-friendly experience on mobile devices. I just want to confirm here that fintech companies by themselves are not cryptocurrencies. The fintech is financial technologies. We are using the existing network of banks to deliver a better and quicker and efficient way of transaction to the customers. This is DeFi. We must have heard this word also, DeFi. That is decentralized finance. It is an umbrella term for a variety of applications and projects in the blockchain space. So the blockchain is the technology behind when a fintech company, for example, I put it this way, when a fintech company uses blockchain technology to give service to its customers, that is called decentralized finance. And most of the central banks are now looking for DeFi so that they can grow more into the financial inclusion space where people don't have bank accounts. It is said that 30% of the world population don't have a bank account yet. 30% of world population doesn't have a bank account yet. So DeFi is one thing that is actually going to change the way the finance world sees the world. There are financial applications built on blockchain technologies, typically using smart contracts, what we call. What are smart contracts? Smart contracts are automated enforceable agreements that do not need intermediaries to execute and can be accessed by anyone with an internet connection. So this is the automatic transaction or contract that happens when I use my mobile phone with a DeFi company. I have the contract automatically. I don't have an intermediary to be done, and I have got my money for the loan which I want to take. Then this is one point to be noted: is the crypto tokens. Tokens are units of value that blockchain organizations or projects develop on top of existing blockchain networks. While they often share deep compatibility with the cryptocurrencies of that network, they are a wholly different digital asset class. Cryptocurrencies are the native asset of a specific blockchain protocol, whereas tokens are created by platforms that build on the top of those blockchains. For example, Ether is the cryptocurrency native to the Ethereum block. But here are many other different tokens that can utilize the Ethereum blockchain, like DAI, Link, Comp, CryptoKitties, among others. There's so many other tokens I can create out of the existing blockchain. When I create a blockchain, I have a cryptocurrency for the blockchain, which is actually native to it. For example, Bitcoin, when I create a Bitcoin blockchain, I have created a Bitcoin as a currency which is native to it. If I issue tokens out of this Bitcoin thing, that can be called as token. These tokens can serve as multitude of functions on the platforms for which they are built, including participating in decentralized finance mechanisms, accessing platform services, and even playing games. So crypto coins can be used just even for playing games. This is the coin created out of nothing. It's like tokens which we give. Cryptocurrency wallets. These are like normal personal wallets which you hold. So cryptocurrency holds your purchase cryptos. When you hold a crypto in a wallet, it's called cryptocurrency wallet. It's like similar to your digital payment being done on Amazon Pay or Paytm, where you have digital currency, that is the electronic currency which you are holding. But if you hold that in a cryptocurrency in a wallet, it's called crypto wallet. Generally, they are different from traditional wallets because they come in different formats and different level of securities. Then the one point which were non-fungible tokens. These are slightly different from the tokens. The NFTs, which you call, are unique cryptographic tokens that exist on a blockchain and cannot be replicated. They are non-divisible. NFTs are cryptographic or digital assets that represent real-world objectives, both tangible and intangible items. It can be either art, GIF, collections, videos, or anything. Even your virtual avatar or video game skins also can be NFT. For example, Twitter co-founder Jack Dorsey sold his first ever tweet as an NFT for USD 2.95 million. What he has done is created a NFT, non-fungible token, of the tweet which has first done it. The first tweet is actually created an NFT, that's a digital asset which he has created, and this has been sold to someone at crazy valuation, and people buy that. So NFT helps the artists and content creators to monetize their work. So if you're a painter, you create an NFT for that artwork using a blockchain technology with a unique identifier code that cannot be replicated. So you have created an NFT, and that painting which you have done is electronically modified, and you are holding that right. So as a creator of NFT, you want to sell this to someone, and the purchaser of this NFT, rather than owning a physical item which you have made, owns a digital file for which they have full ownership rights of that NFT. So though the buyer of this NFT is holding the NFT, he is actually the owner of the physical painting which you have done. But I have created this NFT in a token format and actually created a digital asset. This is the digital asset. So one point to be noted in this NFT is it can't be replicated. Once I create an NFT, that is a unique code only for that purpose. You can't duplicate it. That is the reason why people, whatever thing they want to, content creators who want to monetize their work, they create an NFT and sell them, and that gives them authenticity that he is the owner of that particular item of sale. And NFTs are non-fungible. That means it can't be interchanged. Whereas the cryptocurrencies which you just saw in the last slide, crypto tokens can be fungible because one can be replaced with other. The value is going to be same. And NFTs can't be divided. So these are a few jargons which I thought I'll make you aware about it, because these are the few things which keep hearing, but we ignore it, saying that I can't understand this. I hope I did justice to this particular part of explaining the jargon in a simple words. Now, cryptocurrency prices are extremely volatile because there is a great deal of disagreement on their fundamental worth and whether they are just a fad, a tool for drug dealers to launder money, or a promising concept that will overtake fiat currency in the future. Governments are very protective of their monopoly power to print money. Because cryptocurrencies are digital and global in nature, it makes it very difficult for any specific government to eliminate them altogether. But regulators are very skeptical of and hostile towards them. Hard to predict what will happen in the future, but the most likely outcome, in my opinion, is that they will continue to coexist with the fiat currencies like dollars. So the cryptocurrencies are going to coexist along with the fiat currencies. As I was telling, there is an evolution that keeps happening. They will also likely to see offshoots or applications like the growing trend in decentralized finance are defined. Interestingly, central banks have explored issuing competing digital currencies called central bank digital currencies, which would be a legal tender. That's what we have seen Mr. Ravi Shankar, the Deputy Governor of RBI, speaking recently that they are keen on issuing the CBDCs. He's working keenly on that. And our finance minister has already made an announcement in the budget. They're going to come out with a digital currency in 2023. So before we get into the CBDC, we'll just understand what a digital currency is first. A currency which we use currently is a representative money, which is essentially a debt instrument with the underlying liability of the issuer, that is RBI in our case, and an asset of the public holding. Whoever is holding a currency, it's an asset for him, and it is a liability of the issuer, that is the RBI. Currency is usually issued by a sovereign. Private issuance of money is not as good, as the credit of that issuer. If you see a deterioration in the credit rating of the person, the currency is going to go down the dogs. The currency is usually issued by a sovereign, and that's where the people have trust. Currency involves seigniorage gains. Seigniorage gains are the difference between the intrinsic value and the representative value of the currency that he accrues to the issuer. As we are talking about, the 500 rupee note may be costing about 4 rupees, but the value it represents is 500 rupees. So the remaining 496 rupees is the seigniorage gain a currency gives to the issuer, that is the government or the RBI. The seigniorage gain should not accrue to any private individual, but to the government it can be given, which can be used for public spending. So the difference of the seigniorage gains which you gain, it will be used for public spending. So dollar as a reserve currency right now, he is enjoying seigniorage gains. He can print any amount of money because people have demand for dollars. So he's enjoying the seigniorage gains, but with the threat of cryptocurrencies coming in, and with Russia saying that we don't have faith in dollar, they may slowly lose out on the seigniorage gains which have been holding the economy for long. With the borrowing, huge borrowing they have, the liabilities they are having, they're able to enjoy a developed country status mainly because of the seigniorage gain. This is all going to go down the drain if people start losing value for the dollar. That's a subject altogether different for us from our case. That it can be another lecture altogether. Coming back to our topic, currency is usually issued in paper or polymer form. Of convenience and with the process of credit creation, most of the currency is held in digital form. Example, balances held by banks in e-Kuber account is digital currency, which if needed can be convertible 1-to-1 into paper currency. Now we move on to what is CBDC. CBDC is a legal tender issued by a central bank in a digital form. It is the same as fiat currency and is exchangeable 1-to-1 with the fiat currency. It exists purely in the digital form without a physical manifestation. Transactions are recorded in a centralized ledger and central banks retain full control over the supply. CBDC enjoys a combination of factors, namely, it has the universal access, it is an electronic form and has the backing of a central bank. Example, when you transfer funds from your bank account to your father's account at another bank, and it happens digitally, it's a digital currency that actually moves. However, in case of a CBDC, this type of transaction need not pass through multiple banks and take few business days to get these things done. It could happen nearly instantaneously on one digital ledger. The idea of CBDC stems from cryptocurrencies and blockchain technology, but CBDCs are not cryptocurrencies. CBDCs can be based on blockchain, but they do not need to be a cryptocurrency. More than 100 countries are exploring CBDC at one level or other at this point in time. The Bahamas are the first one to roll out a CBDC that's called as Sand Dollar in October 20. Sweden has completed a technical pilot, while China, which they call as ECNY, digital renminbi, continues to progress with more than 10 crore users and billions of yuan in transaction. Europe wants to launch a digital euro by 2025, while the UK government has launched a Bitcoin task force, and the US is carrying out a research to test the credibility of CBDC's programs. IMF is also working on supporting the interoperability of the CBDCs. CBDCs need an underlying system for issuance and distribution to the public in a convenient way. Depending on the model adopted, the whole ecosystem needs various players to function, including RBI, banks, payment service providers, financial institutions, application or third-party service providers. However, the issuance model may not be inherently different from the current system of current issuance. RBI and banks may need to adopt a parallel end-to-end blockchain-enabled system for CBD issuances and circulation in the time to come. Digital currencies possess multiple advantages over the traditional counterparts, including the lower printing costs, avoidance of time zone issues, lower transaction costs, reduced settlement risk, greater transparency, increased transaction speeds, real-time and cost-efficient, globalization of payment systems. CBDCs are they are akin to stable coins, but with enhanced security and stability features. So CBDCs have the advantage of a cryptocurrency, but the stability in the value of CBDCs are going to be higher because it's backed by a sovereign government. Stable coins, there can be an issue in relation to the management. The guy who's going to manage the stable coins may not actually manage it the way we want. It's like mutual fund tracking a index. If the fund manager is not able to track the index properly, he's going to make loss for the investor. Similarly, stable coins. If you're not able to manage the portfolio properly, if you're not able to manage the gap properly, there can be a mismatch issues that can happen, and it is still volatile and it is a risky. Digital rupee is the CBDC of RBI. They have the nomenclature given by RBI's India's CBDC is digital rupee. CBDC will remain a complement and not a replacement of cash. It is issued in lieu of the paper or metal currency. What are the drivers for issuance of CBDCs? For advanced economy, the robust safety, promote safety and robustness and domestic payment efficiency, it is required. In case of an emerging economies, where most of the people don't have bank accounts, financial inclusion is the main motivation other than the domestic payment efficiency and safety. What are the potential benefits of CBDC? We take 2-3 points and see how it can actually help us out. Programmable payments. Once we have a CBDC in place, we can have a fit for purpose money used for social benefits and other targeted payments. Example, a pre-programmed CBDC could be issued for LPG subsidies for direct benefit transfer. The CBDC could be accepted only at authorized LPG agencies and will be declined at any other area. So we are programming a payment that is used that has to be used only for that purpose. So once I issue a CBDC of say 1,000 to the eligible parties, he can use it only for LPG subsidization and for anything else. So they can program the payments or social welfare measures which the government take in a clear-cut format, not missing the actual target. So LPC agencies, when they receive that form, they can further convert these back to fiat currency on a one-to-one basis with any commercial bank that is authorized to do so. Cross-border remittances. Once we have a CBDC and the counterparty, our other country abroad also, as for example, US has got a CBDC, and we have a collaboration in place and the required infrastructure in place. The payments that have to be made from India or from US can be on a real-time basis, and you can do it 24/7. You don't have any intermediary required, and the payment across borders can be achieved instantaneously. Retail payments. Payment instruments must be made available for payment transactions via CBDCs. Retail CBDCs could be distributed by RBI or banks in separate wallets. CBDC offers instant settlement, so it lowers the risk in clearing and settlement of retail payments. So as we can see this, we're talking about CBDC going to give us instantaneous payments. So that anyway, our UPI also does the same thing. UPI currently which you are having is the best in the world, and I think no other country has got this kind of mechanism where I instantaneously make the payments. So when UPI is there for India, why we need CBDCs? Problem is there's preference of cash for its anonymity. UPI payments are trackable and can be immediately tracked by anyone you want. But once India is a cash preferred currency till recently, now also preference is there for cash. Can be related to accept CBDCs as long as anonymity is assured. People can start using CBDCs. Large cash usage can be replaced by CBDCs. The cost of printing, transporting, storing, and distributed currencies can be reduced drastically. Developing countries are developing our own CBDC will help the public not falling prey to the other kind of virtual currencies that are there in the market right now, which are actually taking the people on a wrong thread. People may lose completely their earnings or the investment which they made if they don't get in and it can't be checked. So by having your own CBDC, people may be incentivized who wants to use a virtual currency to use our own currency. So CBDC makes case for us in this particular case. There are few issues to ponder on what kind of CBDC we need to arrive. As I've been telling, there can be different kinds of CBDC. It can be retail CBDC or wholesale CBDC. But what is required? That's what is the thought process going in the RBI right now. What kind of CBDC is to be required? And what are the points to be seen in this particular case? Scope of CBDC. What should be the scope of CBDC? What should be the payment made for? Is it for wholesale payment or retail payment? For a wholesale payment, the transactions are UPI based, and most of the people are already, not most, everyone, any wholesale payment is usually having a bank account. The payments are done smoothly. So the RBI needs to take a call here whether they want to make the wholesale payment or only the retail payment. Retail payments can be done for as small amount as a 1 rupee transaction also. So if you see, the retail payments are huge in volume, but very less in value. Whereas wholesale payments are lesser in volume, but very huge in value. So the RBI, this is one point which we need to ponder: what kind of CBDC we need to evolve. If I want to control the wholesale payment, then we can actually not have a CBDC for wholesale payment because that will be tracked separately. And for retail payment, we need not track for smaller amounts. So we can have a cap set there that retail payments up to so and so amount can be using the CBDCs, which can't be tracked, which can be used on blockchain. So that call we have today, that is one point we need to ponder on what kind of CBDC we need. Second one is the technology, underlying technology. So CBDC can, as we already discussed, CBDC can be based on a blockchain technology or need not be based on a blockchain technology. So the call has to be taken whether we need to have it on a distributed ledger, that is a centralized ledger, distributed ledger or a centralized ledger. Where the choice of technology should be varying according to your cases, like what we have discussed. Retail payments above certain amount has to be on a distributed ledger where I need not have anonymity. Whereas a certain amount which is below transaction, I can have anonymity in that particular case because that's not going to be a huge threat to the country anyway. So small amounts can be done on a distributed ledger where automatic things start flowing and the transaction completes immediately. So this is the call we need to take, whether we need to have it on distributed ledger, that is the blockchain technology, or a centralized ledger, that is the bank's books. The validation mechanism, whether token based or account based. Again, it boils down to anonymity again here. If I have a token based validation, then I need not necessarily have anonymity. I will have anonymity there. But if it is an account based validation, then it is actually trackable and it doesn't have the anonymity factor there. Coming to this distribution architecture, whether the direct issuance by the RBI or through the banks. So we need to take a call whether I need to have an intermediaries working for this. Where when you think of an intermediary, it slows down the process. So the RBI has to take a call again, coming back to the same thing. To a certain amount, CBDC can be used for direct access to RBI. Beyond that has to be through intermediaries. So that's the call we need to actually take on. These are the issue, one of the issues to be pondered about. And degree of anonymity, for how much quantum of currency can anonymity be allowed. These are the few points that have to be assessed before any central bank takes a call on getting into the CBDCs, because there are pros and cons for both digital currency, that is the cryptocurrency, or the CBDC. It can have the feature of a cryptocurrency or distributed ledger with them, or it need not have. So CBDCs currently countries are evaluating how it works. As we have already said, there is the evaluation process that is going on, and we need to take a final call what exactly we need. And we can never have a final answer at one shot. we keep evolving our requirements as and when we go. So now to summarize my presentation, I want to put one small presentation on the differentiating factor between these two. What is the type of differentiate is the type? So fiat currency is real or physical, whereas cryptocurrency is virtual, and digital currency also is virtual. And as a differentiating factor, sovereign, which is government backed. Yes, fiat currency is backed by central bank or the government. Cryptocurrency is not backed by anyone unless and until it is a stable coin. It's private sector issued. Digital currency is backed by central bank. Decentralization. Central bank controls completely the fiat currency, so it is not decentralized. Whereas a cryptocurrency is controlled by complex math, so it is completely decentralized. It is by across the peer-to-peer network across. And digital currency, again coming back, is a centrally controlled, central bank controlled currency. Coming to the intermediaries, fiat currency will have intermediaries, whereas a cryptocurrency is a peer-to-peer technology, so there is no intermediary, or the intermediaries are very, very minimal. And in case of a digital currency, it all depends on what kind of model we want to have, retail model or wholesale model, or what kind of model we want to have. So we can work on either side, take the pros and cons of both the things, and we can actually have a call on that. Coming to the portability. Yes, fiat currency is portable, except big quantum of cash. Cryptocurrency is highly portable. I can transfer any amount I want. Digital currency also has the embedded advantage of transferring any amount I want. We want to transfer, but again, the system, the requirement of control is going to be required here. So this is the central bank's call on how much amount he can allow it to be ported easily. Now, the durability. Fiat currency is moderately durable. It can be worn out over a period of time, but the cryptocurrency is highly durable and digital currency is highly durable. Volatility. Cryptocurrencies are very, very volatile, whereas your fiat currency and digital currency, which is backed by the fiat, is very, very low volatility. So the store of value for that particular currencies are very high for fiat and digital currency. Acceptance. Fiat currency can be accepted nationally. Rupee can't be accepted anywhere else. It can be accepted only in India. Of course, with the new direction which I'm seeing with this Russian-Ukraine war which is happening, now Saudi started accepting yuan payments for its oil, and Russia is demanding that euro makes the payment. Anyone who wants to buy oil from Russia to make the payment in ruble. So these are the factors that keeps changing dynamically. But as of now, fiat currency is national. It is cryptocurrency. It is global currency and it can be accepted across the globe, provided they want to accept it. Digital currency again is national. Security. Coming to security, fiat currency has moderate security, which is already discussed. It can be counterfeited. There is a possibility of counterfeiting, but cryptocurrencies and digital currencies have very, very less chance of being counterfeited. Smart. So are they programmable? Fiat currencies are not programmable because they are physical, whereas digital and cryptocurrencies are involving complex maths, so they can be easily programmed. Scarcity. Fiat currency, the scarcity is very, very low. The government, if he wants, he can pump any amount of money he wants. Whereas in a cryptocurrency, there is a limited supply available, except for a Ethereum kind of a blockchain where there is unlimited supply. Digital currency, again, coming back, it's being controlled by government or Central Bank of India, the Reserve Bank of India. So this is very, very low. Anonymity. Identity tied up to your existing bank account. Whatever your transaction you do, it can be easily tracked. In case of fiat currency, in case of a cryptocurrency, you enjoy complete anonymity. You don't know who is the transaction. The very fact, as I was told you, we don't even know who is the founder of Bitcoin right now. We know the name Satoshi Nakamoto, but we don't know who he is. What is his physical avatar? We don't even know whether he's a male or a female or is a group of people. We don't know anything about it. So we can have absolute anonymity in this case. In case of a digital currency, identity tied up to existing bank account, or If I want to, we are talking about retail payments, you can have a anonymous tag given there. In such a case, anonymity can be maintained. With this, I end the presentation from my side. Unless you have got any questions, I'm willing. I'm ready to take any question if you have.
Thank you, sir, for your elaborate presentation. I request all the participants to kindly give your feedback or questions, if any, so that we can raise the point to our honorable chief guest and presenter, Mr. Vikas Babu. In the meantime, I request Shamal Ghosh, sir, to kindly pitch in, and if you have any such questions which are relevant, you can also pitch in till the time we receive any questions from the participants. Shamal, sir.
Okay. Because can you hear me?
Yeah, sir.
Okay, nice presentation. Needless to say, as you do it, see, there are one or two things which I would like to say. One of my questions were, how long crypto is going to survive? How long crypto is going to survive, which you have cleared that crypto is going to exist along with the fiat currency of US dollar. Okay, that you have already
They
mentioned.
complement each other. It a different format, not in the existing one. It may not be an existing format.
Okay,
but they complement each other, and
my question is different. My question is that, your CBDC is coming to counter cryptocurrency. That is what RBI says. Yes. But you have made it clear that CBDC is not cryptocurrency. Yes, people need
not necessarily be a cryptocurrency. We can make it a cryptocurrency.
Fine. People love to have speculation. That is why they are thronging around this cryptocurrency. And the kind of ups and downs and speculation that you see in cryptocurrency, my question is, will that kind of thing happen in CBDC? Then if not, then why people should have interest in CBDC? This is my question.
Sir, as I have already informed, CBDC makes the transaction very, very cheap. Yeah, first of all, first answer to the first point, there can't be any volatility in the currency, CBDC. The volatility in rupee is equal to the volatility in digital rupee. You don't have any other volatility there. It can't be listed separately because it is backed by sovereign. The value of rupee is same whether it is in digital form or physical form. Now, coming to the second point, why we need CBDC when there is no volatility there in the currency. See, CBDCs are being used, as I have given an example, where there are 3-4 points where the government actually can do the direct benefit transfers through CBDCs to the exact required people. So you can program the welfare scheme which you want to make. That's one point. Second thing, for people who are unbanked right now, with CBDC, using a mobile phone, you can have a CBDC in your mobile phone. You can use that for making the transaction. You need not have a bank account there. Again, it depends on what kind of model RBI wants to adopt. But there are the advantages of cryptocurrencies which can be used to enhance the banking presence across the country. And as I was told you, because of the ease of doing business with cryptocurrencies, people are actually going for cryptos. So just to divert people from going into the private cryptocurrencies, they want them to use the CBDC. That is one incentive which RBI is seeing, that we have to give incentive for people to work on this kind of transaction where the transaction can be seamless without any hitch in between.
Fine. But my question, one more question I am having, which I presented to you in the very beginning. the imposition of tax of 30% for transfer of for income from the transfer of virtual assets. Do you think that this is in fact remove the uncertainties about the legal status of such transactions like in cryptocurrencies, and this is one sort of making crypto trading official? This was my question in the very beginning, what I said.
Sir, as far as I perceive it, the tax was levied only to ensure that speculation that is happening in the country on cryptocurrency is disincentivized. That is the major reason why the tax has been levied, and just because you are taxed doesn't mean it is illegal. That's one thing, one point we have to understand. As I was telling, the average age of a crypto holder right now in India is 26. Can you just understand? This 26 is the average age. The person who just came out of the college was investing in cryptocurrencies. They don't know what the value of money is. They have seen only 1.5 year experience where the market is only moving one side up. They have not seen the other side. Though there intermediary fall that is happening, but in a span of 3-4 months is actually at the same level. So people have, as Indians now, we always have the tendency to speculate. So just to curb that speculation activity in the public, they are coming out with a tax disincentivizing them not to trade in cryptocurrencies. I think that's the reason why the tax has been come, and it's got nothing to do with the legality of the cryptocurrency. The legality is not yet clear. We have not come out with any policy yet. We have never said no or yes yet. But tax has been levied just to disincentivize the people not to get into that kind of trading.
Okay, because my last question to you is on behalf of the common listeners, is that today I found the value of one Bitcoin is 33.95 lakh, which is I have seen this, and closely followed by Ethereum, which is 2.56 lakh. My question is, why many people they ask why the value of Bitcoin is so much? Why the value of, is it because it is a scarce commodity, or is it because of it is very speculative? And what is the reason? What are the reasons?
Sir, you have the answer which you already mentioned. They are creating artificial scarcity here. First point to be noted is Bitcoin is the first used cryptocurrency. And people, when they say cryptocurrency, they have only Bitcoin in mind. Ethereum actually slowly taking a place, but Bitcoin is the one that is a brand image that has been created for cryptocurrencies. So there is craze for it. People don't understand the fundamentals behind it. There is a craze for it. And one more point to be noted, the artificial scarcity is being created. 84% of the cryptocurrencies are held by 1.5% of the population who are holding it. So the remaining people are only smaller lots. So this is an artificial scarcity being created. When you see there is less supply, obviously demand is going to be higher and the value has to shoot up. That's what is happening in the case of Bitcoin. Otherwise, there is no value to it. If tomorrow, if RBI says it is illegal, then what all money you are showing at 33.5 lakhs is gone in vain.
Nice.
Basically, the creating the scarcity, and that is why value keeps jacking up. The way I should not be using this, but what happens in a illiquid stocks in the equity market? You can do anything you want with that. That's what is actually happening with Bitcoin. And there is a brand image for the Bitcoin, so people know it. So without realizing what the actual value is, and we already have that key of speculation. Added to that, it is actually giving a push up to the Bitcoin value.
Thank you. Thank you very much.
Thank you, sir. I think we have got two questions. First question is from Mr. GSK Verma. He has asked difference between digital currency and cryptocurrency, and please give an example so that it can be understood in a better manner. Sir, over to you, sir.
Yeah. Sir, one point I want to, I think I already given the difference here. These are, see, the crypto, as a simple answer for this is digital currencies evolving currency. It can have the advantage of cryptocurrency backed by a fiat currency, backed by the issuance of the government of India or RBI. So that is the simple answer. All digital currencies need not be cryptocurrencies. There is the evolution that is happening. As of now, there is no format to decide what to be done, because unless we come out with a model for digital currency or CBDC at our end, at India or any other country, we can't say what exactly is the difference, because we have not have a CBDC as a product ready yet. Once we have the product ready, then we will be able to give a clear answer. But as of now, the answer is that cryptocurrency, digital currency has the advantage of some cryptocurrency concepts. Otherwise, it is still an evolving concept.
Sir, we have another question from Mr. V. Srinivasan. He has requested for what is the cost of crypto mining? Like whether the cryptocurrency can do millions of transactions to facilitate larger public to use it at what cost? What is the cost of mining? Like we don't know the cost as of now for all the cryptocurrency.
To give an example with Bitcoin, initially when it started in 2008, the cost of mining was hardly anything. It started with value of $0.01 per one Bitcoin. Sorry, one Bitcoin is equal to $0.01, right? Exactly. So the cost of mining at that point in was very, very less. The power consumption was less and the mining concept was less, because you have just started the chain there. So you have only 3 or 4 transactions, you create a chain, you get it validated, you get the Bitcoin as your mining. So the cost was very, very less. But now if you talk about the mining, it takes about 187 days as of now to create one Bitcoin traditional. The cost can be actually, we don't know how many transactions have to be P2P network consensus mechanism ke saath we have to get it done. So as of now, we don't know what's the cost involved there. So creating a Bitcoin, one Bitcoin right now can take 187 days. That's the approximation right now. But if you go into a new cryptocurrency, if I create a cryptocurrency now, initial time the cost is lower because the transactions that have to be authorized are very, very less. So as you go into the thing, you have got a limited supply, as we already said in most of the cases. The cryptocurrency depends on which crypto you're talking about. And the costs are physical transactions, the network of transaction, power consumption. These are the major costs, and we can't put a point of number to that particular transaction at this point in time, because it changes with currency to currency, cryptocurrency to cryptocurrency.
Thank you, sir. Another question from Payal Banerjee. She has asked whether any ETFs are there for cryptocurrency.
Yes, there are some ETFs in US which have started for cryptocurrencies. So one advantage we have got in ETF is the diversification. Even if one cryptocurrency or exchange goes bust, at least you are partly saved. But all said and done, I am a person who is not comfortable with the cryptocurrency because we don't have an intrinsic worth as of now with it, and it's not backed by a sovereign government. You can be taken for a ride once things fall in place. ETFs are available in world now, in US right now. In India, it is not yet allowed. We don't have an ETF in India.
Sir, another pertinent question, like whether any loss, if anybody suffers from trading in cryptocurrency, can it be set off with the profits?
No. It has been made, as I told you, they are trying to disincentivize the people to actually trade cryptos. So your losses can't be offset with your profits. So cryptocurrency loss can be, one cryptocurrency loss can be offset with the other cryptocurrency loss, same cryptocurrency. If you're doing in Bitcoin, loss in Bitcoin can be offset with the profit in Bitcoin, but loss in Ethereum can be offset with the loss in Bitcoin. So that's the kind of law that is actually being done right now. And your short-term loss in other currencies can't be offset with the profits in this. So they are trying to disincentivize people to get this done completely.
Right. Thank you. Another question is that only one country in the world has mandated this cryptocurrency, like I think in South American country, El Salvador. Why you think only such low, I think, acceptance in the world So is it so popular, but why it is not getting accepted by the country as a legal tender or legal currency?
Sir, your economy is stable because of a monetary policy in the place and a central bank in your country. If you are going to give a monetary powers to any private individual, the country can't run on its own. So no country or central government or central bank wants to give the power of monetary authority to anyone else. Very fact that I am giving cryptocurrency a legal status gives monetary authority to someone. When I give cryptocurrency when I legalize the cryptocurrencies, my monetary policy will not work because I don't have power to influence the market. I don't have the power to influence my way money has been used. I can't curtail the supply there. I can't actually increase the supply if I want. So I can't do anything with my monetary policy once I give legalized cryptocurrencies. So there has to be control by the central government or central bank of the country to have monetary policy intact, and economy also is being controlled. Otherwise, if cryptocurrency is given a free hand, your country can go anywhere. No one can actually control if things go wrong. That is the reason why no country in the world wants to do it. And people who are trying to do it are very, very small countries with insignificant share in the global markets. No major economy will take a call. That is the reason why they are transitioning the advantages of cryptocurrency into in the form of CBDCs. That's the evolving concept, as we were telling. It's almost for 2.5 years. IMF also is working on the same transactions. They have not come out with a conclusion yet. And China is the only country who has come out with a major country who has come out with CBDC, and they're doing transactions billions every day. Almost 10 million users are there in different bigger cities of China. But still, it is backed by sovereign. So they are giving advantage of sovereign status to the CBDC, and they want to internationalize their yuan. So they are using the digital yuan as a theme to counter the USD across for the international payments.
Thank you, sir. Sir, I think it is our last question. Mr. Srinivasan, he has requested that if authorities who are actually regulating this cryptocurrency, suddenly they vanish in thin air, what do you think, what would be the future of the investors or the speculators?
You get nothing. You get nothing. If a bank is closed, it vanishes. You get nothing. In cooperative banks, it happens. You suddenly find a board that we are out. So you get nothing there. At least there is some insurance there. You'll get that insurance amount for your deposits. But here you're not going to get anything. It is only a digital form. You're going to have it in your hand and you can't do nothing with it. That is the reason why, as I was telling you again, no one wants to legalize it because no one knows where it can go to. And as I was telling you, it is an anonymous transaction. We can't even track it.
Thank you, sir. I think we had a great learning experience today, and we would be closing our this webinar by a vote of thanks, which I feel it is an honor for me to give. Being from the BFSI department, I thank wholeheartedly. This was an excellent presentation from our chief guest, Mr. Vikas Babu, who is the DGM of Union Bank of India, for gracing today's occasion as the chief guest and also the main presenter. And he has given an exhaustive presentation, and he has covered everything like fiat currency, cryptocurrency, central bank digital currency in such a exhaustive manner. Everybody, any lay person can understand the nitty-gritties, and in and out, the understanding, they will have the understanding of what it is. And we also thank wholeheartedly our chairman, CMA Chittaranjan Chattopadhyay, who is our chairman for last 3 years, for giving his welcome speech. We also thank Mr. Rajkumar sir, who is an advisor of our BFSI board, for his guidance, this program we are actually doing. And also our Shamal Ghosh Rai sir, he has joined us, I think from 1st April he has joined as main consultant of BFSI board. He is the former GM of Andhra Bank, for whose idea, and he knew our chief guest, Mr. Vikas, from his trading days or treasury days. in Mumbai. And I thank Shamul sir for giving that excellent idea for organizing this webinar on cryptocurrency. We thank our HOD Arup Shankar Bakshi sir, whose guidance we always seek for organizing such programs. We have a small team, our Dr. Madhumita Sen Gupta, Joint Director, Aditi Raj Gupta, Joint Director, Payal Banerjee, Associate, Indrakshi Bhattacharya, Assistant, Grade 1, and also Shantanu Pradhan, Associate, for whose assistance and cooperation we have made it possible to make it live for you, all members and others, this program. Many of the bankers have joined from across the country. We have got the feedback as per the attendance sheet. We thank everybody for being a guest, and please share your feedback. Give us any other feedback which you feel we can do. Give us the topics which you feel we can organize for our webinars in coming days. And also we thank our IT team who has made it possible so that this program we could do in an online forum. And with this, we come to a close. We thank you everybody for gracing this occasion. Thank you, sir.
Thank you.